Ever wonder how Warren Buffett, the so-called Oracle of Omaha, amassed his fortune? You're not alone. This unassuming man from Nebraska has been captivating the world with his financial prowess for decades, becoming one of the wealthiest individuals on the planet. His secret? A unique investing philosophy that has proven to be remarkably effective. Warren Buffett, for those who may not know, is the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company. But he's not your typical billionaire. He's known for his frugality and down-to-earth persona, a stark contrast to the ostentatious lifestyles of many of his peers. A man who still resides in the home he bought in the late 1950s for a modest $31,000, his approach to life and wealth is as fascinating as it is inspiring. Buffett's success in the stock market is legendary. He made his first investment at the tender age of 11, and by the time he was just 15, he already had a net worth of over $6,000. Quite the precocious investor, wouldn't you agree? His uncanny ability to pick winning stocks has earned him the nickname, the Oracle of Omaha, a title befitting his prophetic knack for investing. But what's truly intriguing about Buffett isn't just his financial success, but the principles that guide his investment decisions. He's not a man of complex algorithms or high-frequency trading. No, Buffett's approach is simple, grounded in a fundamental understanding of business and a keen eye for value. He invests in companies he understands, never attempts to time the market, and is often fearful when others are greedy. So if you've ever dreamed of amassing wealth like Warren Buffett, you're in for a treat. Over the next few scenes, we'll be diving deep into the mind of this financial titan, exploring his 7 golden rules of investing. These principles have not only made Buffett one of the richest men in the world, but have also stood the test of time, proving to be a reliable guide for investors of all levels. If you're curious to know how Buffett made his billions, stick around as we unravel his 7 golden rules of investing. Buffett's first rule of investing is simple, yet profound. Invest in what you know. This principle, seemingly straightforward, is the backbone of Buffett's investment strategy. It's not about chasing the hottest stock or jumping on the latest trend. It's about understanding the business you're putting your money into. Take Coca-Cola, for example. Buffett, a daily consumer of the beverage, recognized its enduring appeal and invested heavily in the company. Or consider his investment in Geico, a business whose model he understood and appreciated. This rule underscores the importance of doing your due diligence. It's about getting to know the company, understanding its business model, its products or services, its competitive environment, and its financial health. It's about being confident in your investment choices because you've done the groundwork. So, before you invest, take a page out of Buffett's book and learn about the business. Buffett's second rule: never attempt to time the market. Now, this might sound like trying to catch a falling knife in the dark, and you wouldn't be far off. Many an investor has fallen into the trap of trying to predict the market's every rise and fall. But let's face it, if predicting the future were that easy, we'd all have crystal balls on our desks. The truth of the matter is, even the most seasoned investors can't accurately time the market. And this isn't a game of pin the tail on the donkey. Your hard-earned money is at stake. Buffett's approach? He's a long-term player. He's not interested in short-term fluctuations. He's in it for the long haul, investing in companies he believes in. So let's leave the market timing to the fortune tellers. You, like Buffett, should focus on the long game. Remember, it's not about timing the market, but time in the market. Buffett's third rule might surprise you. Be fearful when others are greedy. This principle is a testament to Buffett's contrarian nature and his belief in the power of independent thinking. It's about resisting the urge to go with the flow when everyone else is buying. In fact, it's in these moments of mass greed that the most disastrous financial decisions are made. Think about it. When the market is overly optimistic, prices surge, often beyond what's reasonable. This is when bubbles are created, and we all know what happens when bubbles burst. Buffett, on the other hand, has often capitalized on these situations by taking a contrarian approach. He's bought when others were selling out of fear, and he's held back when others were buying out of greed. His decisions are driven by analysis and evaluation, not by emotions or popular trends. So, don't let the fear of missing out drive your investment decisions. Buffett's fourth rule is all about value. It's far better to buy a wonderful company at a fair price. Now let's unravel what that means. Imagine you're shopping for a car. You wouldn't just consider the price tag, would you? You'd look under the hood, check the mileage, perhaps even ask about its service history. Similarly, when investing, Buffett advises us not to be blinded by a cheap stock price. Instead, he urges us to look under the hood of the company, to understand its business model, assess its profitability, and scrutinize its management team. You see, a wonderful company is like a well-oiled machine. It may cost a bit more, but it's durable, reliable, and likely to give you a smooth ride in the long run. So don't just chase bargains in the market, seek value. In investing, like in life, quality matters more than price. Finally, Buffett's last 3 rules: the power of compounding, the importance of a margin of safety, and the virtue of patience. Let's start with the power of compounding. It's a simple concept, but one that's central to Buffett's success. Imagine you plant a single seed in a garden. Given time and care, that seed grows into a plant. Now, if that plant drops its own seeds, and those seeds grow into more plants, you'll soon have a garden sprouting from that single seed. That's compounding, the process of generating earnings on an asset's reinvested earnings. Over time, even a small amount can grow into a substantial sum. It's like magic. But the only spell you need is time and reinvestment. As Buffett once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Next, we have the margin of safety. This principle is all about minimizing risk. In investing, a margin of safety exists when you buy an investment for less than its calculated intrinsic value. The difference between the price you pay and the intrinsic value is your margin of safety. It's like buying a car with a top speed of 200 miles per hour when you only ever plan to drive at 100. That extra 100 miles per hour is your margin of safety. Buffett's longtime partner Charlie Munger put it this way: the first rule of investing is don't lose money. The second rule is don't forget the first rule. And it's this margin of safety that helps ensure you don't lose money. Our final rule is patience. The stock market isn't a sprint, it's a marathon. Buffett himself often quotes the Chinese proverb, "The man who moves a mountain begins by carrying away small stones." Investing is about moving those small stones day after day, year after year. It's about having the patience to wait for the right opportunity, and the discipline to stick to your strategy even when the market gets tough. In the world of investing, it's tempting to seek quick wins or hop on the latest trend. But Buffett's success lies not in chasing the fast rabbits but in patiently tending to his garden, planting his seeds, and waiting for them to grow. As Buffett once said, the stock market is a device for transferring money from the impatient to the patient. Remember, in the world of investing, patience is not just a virtue, it's a strategy. And in Buffett's world, the tortoise always beats the hare. So, there you have it. The 7 golden rules of investing, according to Warren Buffett. These aren't just arbitrary guidelines but rather the very foundation of Buffett's investment philosophy. A philosophy that has guided him through the turbulent tides of the stock market and led him to become one of the most successful investors of all time. Investing in what you know, refraining from timing the market, being fearful when others are greedy, buying wonderful companies at fair prices, harnessing the power of compounding, maintaining a margin of safety, and practicing patience. These are not just rules, but principles that have stood the test of time. They have been the compass that guided Buffett in his journey from a newspaper delivery boy to the Oracle of Omaha. Now it's up to you to apply these rules to your own investment journey. And remember, subscribe for more content.